the secret to success for great companies. Hey guys, have you ever heard the news about big companies that suddenly went bankrupt? Even though it looks like they have a lot of customers and big turnover. Well, it turns out that business success is not just about money. There is a secret called balanced scorecard that makes big companies remain successful until now. Are you curious? Let's watch the video until the end, guaranteed to make you understand how to measure real business success.
Hello, I'm Sylvie.
Claren.
My name is Nida.
Claren, you know what? I just read the news about a company that collapsed despite having a huge turnover.
It often happens because they focus too much on money, but there's a tool called Balanced Scorecard that can help prevent that.
Balanced scorecard? What is it, Clar?
Hi guys, sorry I'm late. What are you talking about?
Hi, it's okay. We were talking about a company that went bankrupt despite having a huge turnover. It turns out there's such a thing as a balanced scorecard to help companies be more stable, like Claren said.
Wow, what a coincidence. The Balanced Scorecard is actually a management system created by Robert Kaplan and David Norton. In essence, the Balanced Scorecard helps companies turn vision into action.
That's interesting. But how does it work?
The Balanced Scorecard is like magic glasses to look at the company from 4 perspectives at once. The first is the financial perspective. This is the most straightforward, focusing on profit and financial stability. The second is the customer perspective, how customers view and satisfy the company. The third is the internal business process perspective, how efficient the internal workings of the company are. The last is the learning and growth perspective, how the company improves employee skills and knowledge.
So, it's like a report card. There's a lot more about it than just profit and loss.
Exactly, Claren. And in each of these perspectives, there are important components such as goals, measures, targets, and initiatives. So how about we discuss the financial perspective first?
How do we use this financial perspective to value the company?
Okay, so this financial perspective is really important for measuring whether the strategies implemented by the company are successful in increasing profits. Here, the indicators that are often used are OI, or return on investment, profit margin, and operating ratio. The end goal is to ensure that the company can generate profits and manage key risks. In addition, this financial perspective also makes us understand the needs of various parties such as shareholders, customers, and suppliers. Shareholders, for example, want to see the company generate continuous revenue and fulfill goals such as increasing profitability. To achieve this goal, companies usually take certain steps, such as introducing new products or services, increasing the value offered, and cutting operating costs.
Clar, you've analyzed financial statements, so can you give an example of how to use financial indicators from a financial perspective for analysis?
Sure. For example, I analyzed the financial statements of Company X yesterday, and we can see from these 3 main indicators. The first is our ROI, return on investment. ROI is to measure the return on investment that the company has made. The formula is ROI is equal total sales minus investment divided by investment times 100%. For example, PT X invested Rp 20 million rupiah in Company Y in 2023, then sold the investment the following year for 25 million rupiah. So the sale for the ROI was 25 million rupiah minus 20 million rupiah divided by 20 million rupiah times 100% is equal 25%. Then the raw value of the investment is 25%. While in 2024 PTX investment worth 10 million rupiah gets sales worth 15 million rupiah. So 15 million rupiah minus 10 million rupiah divided by 10 million rupiah times 100% is equal 50%. This means a profit of 5 million rupees, so their investment is 25% profitable because the higher the ROI, the more productive the funds used. Next, there is profit margin, which measures a company's efficiency in generating profits from the sales. The formula is equal net profit margin is equal net profit divided by total revenue times 100%. Year 2023 Company X generates total sales of 150,000 with production costs of 120,000 rupiah. So the net profit margin is 55 million rupiah minus 32 million rupiah divided by 55 million rupiah is equal 23 million rupiah divided by 55 million rupiah is equal 0.4 or 40%. So, the net profit margin of Company X in 2023 is 40%. Well, in 2020 for net profit after tax, NPM is equal net profit after tax divided by sales is equal 65 million rupiah minus 40 million rupiah divided by 50 million rupiah is equal 25 million rupiah divided by 50 million rupiah is equal 0.5 or 50%. So, the net profit margin of Company X in 2024 is 50%. This means that the profit they get from each sale is very efficient. The last is operating ratio. Finally, we look at the operating ratio, which measures how well the company manages operating costs. The formula is equal operating ratio is equal total operating expenses divided by total sales times 100%. A company sells products with total sales of 1 billion rupiah. The company's operating costs including production costs, administrative costs, and selling costs are 750 million rupiah. Calculate the company's operating income and operating ratio. Year 2023 operating ratio is equal 750 million rupiah divided by 1 billion rupiah times 100% is equal 75%. Then in 2020 for the operating costs of Company X increased to 960 million rupiah and sales to 100% means operating ratio is equal 960 million rupiah divided by 1 billion to 100 million rupiah times 100% is equal 80%. Well, if the operating ratio is higher than a company, it means that it shows that the company can utilize its costs in generating net sales.
Wow, that's really clear. So, by looking at our OI profit margin and operating ratio, we can better understand the financial health of the company, right?
Yes, the financial perspective is the foundation. If this is okay, we can build the other perspectives better.
Overall, the combination of improvements in these three indicators shows that the company is in a strong financial position, efficient in its operations, and able to generate more profits, so this can increase investor confidence and attract more market attention. Thanks, Clar, for the very detailed explanation. Now I understand why the balanced scorecard is so important for companies.
That's right, Vi. The balanced scorecard allows us to see business success in a more balanced way. So it's not just about profit, but also other aspects.
Agreed, guys. So if finances are stable, we can also build other perspectives better. That's what makes the balanced scorecard unique.
For those of you who watched, don't forget to share this video with friends who are studying business management.
For your attention, thanks for watching.